What if I told you that a company worth roughly $500 million just filed paperwork to raise $1 billion in fresh capital? That is double their entire market valuation. And buried inside those SEC filings from March 2026 is a hidden cost that could quietly erase a massive chunk of every retail investor's ownership stake? Welcome back to Smart Stock Sam, the channel where we cut through the noise and give you the raw, unfiltered breakdown that Wall Street does not want you to see. Today, we are diving deep into the DataVault AI and NYIAX merger, the massive dilution question hanging over every DVLT shareholder right now, and what those latest SEC filings actually say when you read between the lines. We are talking a billion-dollar capitalization strategy, 5 brand-new global exchanges, patented technology, and a growth target so aggressive it sounds almost impossible to hit. So buckle up, because by the end of this video, you will know exactly what is happening, what is at stake, and what question every DVLT holder needs to be asking themselves tonight. To understand why they need $1 billion, we first have to talk about the merger that kicked all of this off. On March 19, 2026, DataVault AI officially moved from a preliminary arrangement to a full definitive agreement to acquire NYIAX Inc. This is not a handshake partnership. This is a total absorption. The goal is nothing short of historic. They want to combine real-time AI-driven asset valuation with a regulatory-compliant liquidity platform. In plain English, they want to take things that are extremely hard to sell, private data, specialized contracts, digital inventory, and put them on a high-speed automated trading floor. And then, the very next day, March 20th, they followed that announcement with a Form S-3 shelf registration. That filing is their official signal to the market that they are authorized to go out and raise up to $1 billion whenever they choose. This is not a maybe, this is a war chest. And they are telling the world they are ready to use it. But how does an AI company actually build a stock exchange? That answer lives in the combination of 2 very different but perfectly complementary technologies. Think of it as the ultimate tech marriage. On one side, you have DataVault's brain, their proprietary AI agents, and their patented data score and data value systems. These tools are built to look at raw data assets and tell you in real time exactly what they are worth. On the other side, you have NYIAX's plumbing, a blockchain-enabled trading infrastructure with high-performance matching engines and automated smart contracts that ensure every trade actually clears, cleanly and compliantly. Merge the two, and what do you get? A unified exchange capable of pricing, matching, and settling digital assets that the world has never been able to trade efficiently before. It sounds like science fiction. But here is the thing. The patents they have already secured suggest they are dead serious about the execution. And that brings us to a question worth sitting with. What happens to the companies that did not build this first? If we dig into the actual asset base, 3 massive pillars hold this entire structure up. First is the ADIO ultrasonic technology, a core and proprietary piece of DataVault's intellectual property. Second is collective audience, which brings strategic advisory and agency services, essentially the marketing and business development muscle to pull enterprise clients into the ecosystem. Third is the AI core itself. But what truly matters here, and what most people gloss over, is the foundation underneath all of it. United States patent numbers 10,607,291 and 11,410,236. These 2 patents specifically protect the electronic continuous trading of variant inventories using their blockchain methodology. This is the moat. If you want to trade data or digital inventory in a continuous, automated way using their specific method, you have to go through them. They are not just building a store. They are trying to own the land that every store in this new economy will have to sit on. So, what exactly are they planning to sell in this digital marketplace? The answer is 5 distinct exchange branches, and the breadth of them is either visionary or wildly overambitious, and right now, it is genuinely hard to tell which. First is the information data exchange for corporate data and real-world assets. Second is the International Elements Exchange for commodities and critical research materials. Third, and this one raised eyebrows, is the American Political Exchange, built to trade political data and advertising inventory. Fourth is the sports-centered NIL Exchange, developed in partnership with Sports Illustrated, which allows athletes to tokenize and monetize their name, image, and likeness. And fifth is the NYIAX Advertising Exchange, which treats media inventory like standardized financial contracts. 5 exchanges, 5 entirely different markets, all running on one unified engine. Here's the question nobody is asking yet. Has any company in history successfully launched 5 global marketplaces at once? Because if DataVault pulls this off, we will never stop hearing their name. To build all 5 of those global exchanges simultaneously, the capital requirement is staggering. Here is the reality. DataVault AI is authorized to issue up to 2 billion total shares to execute this transformation. On March 20th, they filed that $1 billion capitalization target. For a company of this size, that is not a fundraising round. That is a complete restructuring of their equity from the ground up. They are signaling to the world that they are willing to issue a massive amount of new stock to fuel this fire. For management, this is a vision play. For you, the retail investor sitting at home, this is a dilution conversation. And if you are not careful with the math, you might not realize just how much of your ownership is quietly evaporating before your eyes. So let us actually do the math. As of January 30th, 2026, there were roughly 591 million shares outstanding. At the recent price of approximately 79 cents per share, raising a full $1 billion would require issuing approximately 1.2 billion new shares. Let that land for a second. We are talking about tripling the current share count. If you own 1% of this company today and they execute this full offering at current prices, your 1% stake could shrink to roughly 0.33%. This is the dilution reality hiding in plain sight inside those SEC filings. Your slice of the pie is getting significantly smaller, which means the total pie, the company's overall valuation, has to grow at least 3 times larger just for you to break even on a percentage basis. The question is whether management can actually bake a pie that big. And they are not just using one tool to raise this capital. They have a 4-part arsenal. First, common stock, which causes direct and immediate dilution for every existing shareholder. Second, what the filing calls blank check preferred stock, which is a significant power move. The board can issue these shares with special rights, like higher dividend priority or first-in-line protection during a bankruptcy, without even asking existing shareholders to vote. Third, warrants and rights, which are essentially long-dated coupons that give buyers the ability to purchase stock at a set price later, creating a delayed dilution bomb ticking in the background. And fourth, debt securities, interest-paying instruments that, if convertible, could trigger yet another wave of dilution down the road. They can even bundle all of these into packaged units. For a retail investor, this is a minefield of mechanisms that consistently deliver better entry prices to institutional players than to you. So where does $1 billion actually go? The capital is being directed into 5 main streams. A major portion is earmarked for closing the NYIAX transaction and funding future acquisitions. A significant allocation goes toward working capital, keeping the lights on across these massive exchange operations. Then there is product development, because merging AI models with active blockchain matching engines is extraordinarily expensive engineering work. Global marketing comes next, because an empty exchange with no users is just expensive infrastructure. And finally, debt management, using fresh capital to pay off or restructure existing liabilities and clean up the balance sheet before the growth phase begins. They are essentially demolishing the old structure to build a skyscraper, and they are asking shareholders to fund the construction. But here is the carrot they are dangling to make that pill easier to swallow. DataVault is targeting $200 million in revenue for 2026. From their current position, that is a jaw-dropping leap. They are repositioning themselves not as a software company, but as a technology licensing powerhouse focused on high-margin data and acoustic sciences. If they hit $200 million in revenue with strong margins, the company's valuation could multiply in ways that make today's dilution look like a bargain in hindsight. They are essentially arguing, yes, your slice is smaller, but would you rather have a small slice of a skyscraper than a large slice of a garden shed? That is the core of what they call the growth over ownership thesis, and it is a classic high-stakes risk-reward trade-off. On the cost side, severe short-term price pressure, a potential tripling of the share count, and significantly reduced voting power for retail holders. On the upside, immediate capital to fund patented, category-defining technology and the firepower to acquire profitable companies that add real revenue immediately. The bet is that long-term enterprise value will outpace the dilution. If the company's valuation grows 500%, while the share count only grows 300%, existing shareholders still come out ahead. But that is an enormous if, one that requires near-perfect execution across every single stage. And execution is where the risks get very real. The NYIAX deal is still pending. It is subject to strict closing conditions, and if any of those conditions are not met, the entire plan stalls before it even begins. But suppose the deal closes perfectly. The technical complexity of what comes next is unprecedented. Merging DataVault's AI valuation models into NYIAX's live blockchain matching engine in real time is the equivalent of swapping out a jet engine while the plane is at cruising altitude. Engineering delays and cost overruns at that level of complexity could devour that billion-dollar runway much faster than any projection currently suggests. And even if the technology works flawlessly, the human element remains the wild card. The success of 5 separate exchanges depends entirely on behavioral adoption. Will brands, corporations, athletes, and media agencies actually migrate to these new tokenized platforms, or will they stick to the traditional systems they already understand? And then there is regulatory exposure. Federal agencies are currently examining tokenized assets and real-world asset trading with extreme scrutiny. An evolving and increasingly restrictive regulatory framework could restrict or even shut down this entire ecosystem before it ever reaches scale. Could DataVault become the most important financial infrastructure company of the next decade, only to be regulated out of existence before it gets there? That is not a comfortable question, but it is an honest one. When you step back and view the entire architecture, you see a 4-stage cycle that either becomes a flywheel or a failure. Stage 1, capital registration. They secure the billion. Stage 2, technology integration and acquisitions. They build the exchange and absorb NYIAX. Stage 3, market adoption. They attract users, liquidity, and enterprise partners across all 5 verticals. Stage 4, $200 million in revenue, which validates the dilution and creates the momentum for the next phase of growth. If any single stage breaks, the engine seizes. But if all 4 stages execute on schedule, you are looking at a genuine disruption of how data, advertising, political inventory, and athlete IP are traded on a global scale. Before we wrap up, a word that matters more than everything else said in this video. Nothing here is financial advice. Smart stock. SAM is an educational and informational channel. We are not licensed financial advisors, and nothing we discuss should be taken as a recommendation to buy, sell, or hold any security. Always do your own research, consult a licensed professional, and never invest more than you can afford to lose. High-risk, high-conviction plays like DVLT require full awareness of the downside, and today we have tried to give you both sides as honestly as possible. So here is the final verdict on DVLT in 2026. The strategic pivot is real. This is no longer an AI tooling company. It is a comprehensive marketplace play with global ambitions. The dilution reality is real. You are looking at a potential tripling of the share count and serious short-term pressure on the price. And the ultimate bet is whether you personally believe that management can transform $1 billion in fuel into a $200 million annual revenue engine. This is not an investment for the faint of heart. It is a high-conviction play on the future of digital liquidity, patented exchange infrastructure, and the monetization of assets that have never had a proper marketplace before. If you are holding DVLT right now, you are not just betting on a stock. You are betting on whether a small company can redesign an entire corner of the global economy. Make sure you know what you are signing up for, because the slice is getting smaller before it gets bigger, and only time will tell if the pie grows large enough to make it worth the wait. If you found this breakdown valuable, hit that like button, subscribe to Smart Stock Sam for more deep dive analysis, and drop your take on DVLT down in the comments. See you in the next one.